Hello, my name is Michael Knight, and this is
Mine is Brendan.
Kelvin Cummings.
Chloe Panhorst.
I'm Theo Pardee.
I'm Kaylee Tring.
we did our financial analysis on Nike Incorporated. So the story of Nike really starts in 1964 when Phil Knight and Bill Bowerman teamed up with some Japanese investors and established the Blue Ribbon Sports Company. But years afterwards, the two American investors had a falling out with the Japanese and caused a separation in the company. And the Americans split into a new company they decided to call Nike. And that officially happened on May 30th, 1971. From there, Nike moved forward and started selling stocks at 18 cents a share in 1980. And what really allowed them to expand was their two biggest marketing campaigns, with the Just Do It campaign being launched in 1988 and the Bo Knows marketing campaign launching in 1989. The last big event to happen to Nike before the turn of the century was the passing of the co-founder and co-chairman Bill Bowerman on December 24th, 1999. After the turning of the year 2000, Nike jumped into acquiring different companies to build theirs. First was in 2002, Nike bought Hurley, which is a surf apparel company. And 2 years later, they bought Converse for the buying price of $309 million. And after that, they set their sights on buying the rights to major sports brands, with the first one being in 2012, Nike acquired the exclusive rights to the NFL apparel, and in 2015, the rights to the NBA apparel. One of the big things that helped Nike build its brand into what it is today is the athlete endorsements they've had over the years. The first Nike athlete was Ilie Nastase. Ilie was a Romanian tennis player, and he signed in 1972, marking the beginning of all the great athletes they've had. Arguably their biggest endorsement was Michael Jordan in 1984, which also launched the Air Jordan brand, known as Jordans today, which is ultimately successful and one of their biggest brands they have. They then turned and branched out to golf, signing one of the biggest golfers at the time, maybe even ever, in 1996 with Tiger Woods. And then when Michael Jordan got to the end of his career, they wanted to keep that hold in the NBA with star power and signed LeBron James and Kobe Bryant in 2003, as well as Derek Jeter in 2008 to get a foothold in the MLB.
So next we have the current events and how they are affecting Nike. Since the beginning of this year, the coronavirus has been affecting everyone, including Nike. They've closed all of their stores in the United States and some other countries as well. However, they are trying their best to support everyone else. They launched a new product, a full face shield, which you can see pictured here, in support of frontline healthcare workers. They've also donated $17 million to support people and organizations in need all around the world. They also came out with a digital workout library, a live stream workouts by Nike's trainers, and the digital workout challenges where people can compete, which you can also see here. They did this because they wanted to come up with new programs and resources to help customers, athletes, and everyone else reach their fitness goals while staying quarantined at home.
Now let's look at one of the most important financial statement of Nike, the income statement. We have here on the slide the horizontal and the vertical analysis, so let's go over them one by one. Looking at the horizontal analysis, overall, everything increased by about 10% or less from 2018 to 2019. So those are good signs, but also I think that is normal improvement we should see in a company. However, there are two things that catch my attention in this income statement. The first one is the other income or expand account. In 2018, they have expand of 66 millions, but moving to 2019, they managed to make that into income of 78 millions. So that's an increase in net income of about 144 millions in Nike's net income. The second thing is the income tax expand. Before taxes, net income of the 2 years are not too different, but after taxes, there is a drastic change of 108% and about 2 billion from 2018 net income to 2019 net income. All that differences is about the income taxes expense. Nike somehow managed to decrease its tax expense from 2.3 billion in 2018 to about 700 million in 2019. That is roughly 67%, and I would say that is pretty impressive. So now, next we'll look at the vertical analysis. Every account is presented as a percentage of the revenue. In both 2018 and 2019, cost of sale make up roughly 55%, and the sales and administrative expenses make up roughly 32%. So there goes almost all the revenue. The sum of the two expenses is about 87% of the revenue already. Until now, we may still think the 2 years could end up with the same net income percentage, but 2018 actually ended up with net income of 10%, and that is 5% more than 2018 net income. Again, the difference also comes from the tax expenses that we already saw on the horizontal analysis. Overall, I would say the company did a pretty good job as they have positive net income in both years, and we can also see a big improvement from 2018 to 2019.
Next, we have the vertical and horizontal analysis of Nike's balance sheet. For the vertical analysis, each account is presented as a percentage of total assets or liabilities. A vertical analysis of the balance sheet is used to have further insight on how the company is structured, because we can see the relative proportions of account balances. It can also be used to see how that structure changes over time. For 2018, we can see that total current assets made up 67.15% of total assets. The vertical analysis also allows us to see all of the current assets that went into that percentage. For example, cash and equivalents made up 18.85% of the 67.15. We can look at liabilities and shareholders' equity the same way, which can be seen on the next slide right here. It also allows us to see how much debt the company holds in proportion to its assets. Nike's percentage of total of current assets for 2019 is 69.68%, and for current liabilities, it is 38.12%. This shows that they are doing a pretty good job at meeting their current obligations. We can see that they also did a pretty good job in 2018 as well, with the total current assets making up 67.15% and current liabilities only making up 26.80%. It can also be used to see how that structure changes over time. We can look at the vertical analysis at increase or decrease levels and trends. For 2018, we can see that our total current assets has a percent of total of 67.15%, and for 2019, it was 69.68%. The horizontal analysis shows us this change is actually an increase by 9.19%, which we can see also on this slide. So over time, or at least from 2018 to 2019, it seems like Nike's current assets are slowly increasing. If we want to know more about that increase, we can look up at the cash and equivalents, short-term investments, etc., and look at the percentages to get an idea of what is increasing and what is decreasing to cause the total current assets to increase. This shows how the vertical analysis and the horizontal analysis sort of go hand in hand. The horizontal analysis provides a year-to-year comparison of performance using the earliest year as the base period. Nike can use the horizontal analysis to see that their total current liabilities went up by 30.23% from 2018 to 2019, which we can see here. They can look at the vertical analysis next to get an idea of what increased or decreased within current liabilities to figure out what caused the major increase in total current liabilities. We can use both of these analyses to see that the retained earnings decreased by 53.28% seen on the horizontal analysis. It went up from 15.61 of total liabilities in 2018 to only 6.93 in 2019, seen on the vertical analysis. If this large drop is abnormal for Nike, it will be something that they are going to analyze deeper later on.
So now let's looking at the common size statements. We are going to compare Nike with Under Armour, which is their biggest competitor, with the most recent information given. So everything looks rather normal until we get to the operating expenses. For some reason, Under Armour tends to have around a 10% higher operating expense. Now, after digging a little into this, it turns out Under Armour has been financially struggling for the past while. And in order to reconstruct their company, their operating expenses are going to be higher for the near future. And they hope to have that lower within the long term, well, short term, hopefully. And this is causing Nike to be, their income to be a lot higher than Under Armour, around 9% higher, which is going to make investors favor Nike over Under Armour as of right now.
And now we'll look at how the company is handling their cash flow. In both 2 years, they had really high number on the operating activity part, but the financing take almost all the money from the operating, so the company end up with just a small part of the operating cash. But overall, in both years, they have positive number in net cash increase, so I think that's a good sign. To go into more details, I also calculated the free cash flow the company have from the operating activities after investing in long-term assets and paying out dividend. They have about 3.4 billion and 2.6 billion in 2 years respectively for new opportunities. So we can conclude the company is doing very good in handling their cash flow.
Okay, we're now going to take a look at some company ratios. We have liquidity. Essentially, this is evaluating a company's ability to pay its current liabilities and how quickly it converts its assets and cash into paying off these outstanding debts. As you can see, I color-coded them to make it a little bit easier to read and judge how well the company's actually doing. As you can see, over $8 billion in working capital, and then a positive rating in the asset test ratio and the current ratio. Those are both, whenever it's green, it's going to be better than other competitors within their sector. Their cash ratio, highlighted in yellow, is just because it's right on average. It's not better or worse than any other competing companies. So as you can see, they do very well in terms of liquidity. Okay, and then in terms of solvency ratios, this is going to take a more of a look at the ability to pay off long-term debt. Their debt ratio, as you can see, is a little bit under the average comparatively with other companies. Their debt to equity ratio, right on par with everyone else. And then their times interest earned ratio, they actually have an extremely high number as they're very easily able to pay off their interest expenses.
Now we get to the activity ratios. Here we see that Nike is selling all of their inventory in a little under 4 times a year. This obviously changes in every industry with different companies selling different products, but the average retail clothing industry is around 3.9. So they're right around average with their activities. This shows with their days in sales inventory, they keep their inventory for about 95 days. And their gross profit inventory or percentage is right at about 45%. It's 0.2 less than their competitor with Under Armour. So these are all pretty average. Nothing stands out too much with their activities. Then we go to the profitability ratios. Now I showed 2018 and 2019 because of the large difference. This comes from, as we've talked about in some of the comparative income statements earlier, that $1.6 billion of income from income tax expense between the 2 years. And another source is 1.5 billion. That's the revenue went up without very much cost increasing with it. So it shows that they just optimized their sales within from the 2018 to 2019 year. And then the rate of return on total assets and rate of return on common stockholders' equity had a bad year in 2018, but bounced back to be right around average. 2018 was a low year. If you look at the past 5 years, they're more like 2019, but it shows that they're able to recover quickly from any type of downfalls.
Now, when looking at global revenue information, it's no surprise that North America is the leading as far as revenue, with around 42% of total revenue coming from North America. And on the lower end, we have Asia Pacific and Latin America only earning around 14.1% of the total revenue for Nike. Now, when looking at the graph, you can tell that Nike earns over 50% of its revenue from overseas or just a different country or continent than North America. Compared to Under Armour, this is huge because they only earn around 15% of their total revenue from regions other than North America. So obviously Nike has done a really good job at investing abroad to increase their long-term revenue. And if they keep doing so, they're just going to keep rolling in the dollars compared to Under Armour, who is currently struggling.
Okay, now we're going to take a deeper look at how the sales break down in terms of materials and demographic. As you can see by this first chart, footwear actually makes up around 65% of their total sales. This comes through their various different brands, such as the Jordan brand that was mentioned earlier and their Nike running series. Next is their apparel at just over 30%. That's going to be your clothing and outerwear. And then equipment comes in at just under 4%. That's going to be like your balls and your pumps and other materials like that. Next, we have a look at the breakdown by demographic in terms of age and gender. Men make up over 50% of Nike's total sales. The women's section comes in at 22.7% of their total sales, and the Nike Kids line makes up just over 16%. And then the other category breaks down a miscellaneous section. But as you can see, the men's clearly dominates their total sales revenues. And then lastly, we actually have a department breakdown, and this is going to be a difference of your sportswear, your Jordan brand, as you can see again, Nike running, soccer, basketball, really just showcasing the sales breakdown within their different departments, just like any other department store would. Okay, now we have, after taking a look at the company of Nike, we are deciding to see if it is a good company to invest in. And these are some noteworthy investing ratios that we took a look at. Their PE ratio is very high. It's at 31.25. Normally, some would consider it to be meaning that Nike is overvalued, but seeing how Nike has a strong track record of consistent high PE ratios, we found that it is actually a good thing because it means that Nike is just a strong company. This is also showcased by their dividend yield and dividend payout. Again, it is very average, midline, but that's something that you want with a company like this. Nike's a global powerhouse, and their dividend yield is right about average, but it's consistent, and that's what you're looking for, is a strong, consistent dividend that's going to continue paying out annually.
So finally, I, like many, would believe Nike is a worthwhile investment, and this is because, just previously mentioned, the ratios are either at average or above average, which is a favorable investment. The total revenue for the company tends to increase year after year, which in terms would make the stock price for the company increase and become stronger. Now, the COVID-19 pandemic has caused the stock price to fall. However, I'm sure Nike will combat this like many other companies will, and the prices will go up. But this is a good chance to invest in the company while it's at a cheaper price, so you could potentially make a bigger profit off your investment. So that is all. Thank you for your time.